Nike just fell 75% from its all-time peak. Is it a warning sign for the rest of the market or an isolated event? We'll take a look at that, plus the leaders and the laggards in this episode. Welcome to the program. I'm Ron DeLegge with ETF Guide. Let's take a look at how you've been doing so far in 2026. We've reached a halfway point. This was on the Community Polls tab, and I am so pleased to report that almost 60% of you are performing better than the S&P 500, according to this poll. Hopefully you're telling the truth. And the rest of you, 40% roughly, are about the same as the S&P or worse. And, this is really a self-reflective time for all of us, whether we're outperforming, underperforming, or performing in line with the broader market. I'd say if we're outperforming, that's great, but take a look at your investments. Why are you outperforming? Is it because maybe you're taking more risk than you should? For those of us that have underperformed, maybe a time to reflect on some of those underperformers. Do we still really believe in some of those positions that might be holding us back? And, the old saying, hold your winners, sell your losers. Sometimes we do the exact opposite. We hold our losers and sell our winners. But again, this is a time of year that we can all self-reflect as investors, traders, see what's going on with our portfolios. Another question that was on the poll or post section of our community poll was your view of the SpaceX IPO, the biggest ever IPO in history. And the vast majority of you, it seems, are rather skeptical about SpaceX as an investment. So interesting poll. Always like to get some feedback and see what you're thinking. In terms of broader markets, if we take a look at the ETF market and what I consider these broad major asset classes, we've got 5. This is since the start of the year. We've got commodities and global real estate leading. STCI, which tracks commodities. You see that it's come down a little bit from its peak, but it's still leading with a gain of just over 18%. Global real estate ahead by almost 14%. That's been making a nice move. S&P 500 is still ahead by almost 7.5%, 8% since the start of the year. And then we've got bonds making a little bit of noise. They've been mostly flat. Now they're just above 1%. We'll talk a little bit about interest rates and what could be coming for rate-sensitive assets and ETFs. I've got some case studies I want to share with you. Well, actually, one case study. And then take a look at IBIT, which tracks Bitcoin, still in the basement. Bitcoin still looking for a bottom. And my hunch is that a bottom will not happen in Bitcoin or the rest of cryptocurrencies until we first see a major crypto player like Strategy or someone else go belly up. Stay tuned for that. When it happens, that will be the time, probably a buying opportunity for those of you that don't have any Bitcoin exposure to jump in. Until then, I think it's premature. That's just my own personal take. Agree or disagree, but that's what I'm watching. Take a look at the cornerstones of an architecturally sound investment portfolio. I pound this every single time we do these episodes, and I'm going to continue pounding it because many of you still, when it comes to constructing and managing an investment portfolio, you are still scrambled eggs and sloppy joes. And it's time to start organizing your investments into these 3 containers. I think it's a smart way to manage your portfolio. It's the way I do it with my own portfolio. It's what I advise and I recommend. I don't manage any assets. I did that in my former life. I was a registered investment advisor. But my point is that there's the core, the non-core, and the safety. Each of these 3 containers works together. They complement each other, and they do not compete in any way. Now, the ETFs that we just looked on this previous page, I would consider, with the exception of Bitcoin or IBIT, all of them would be what I would call the types of ETFs that could fit into the core of a investment portfolio. Core is typically long-term buy, hold, and these are some examples of major asset classes. And when you're talking about, ETFs that track core asset classes, we're looking at ETFs that are broadly diversified, that are proxies of these major asset classes, stocks, bonds, real estate, commodities. They're proxies. They're not trying to outperform the asset class. They're not actively managed. They're not long, short. They're none of that. They're just trying to track the asset class. That's what a core type of holding should be doing in the core bucket. Non-core is quite different. Non-core is higher risk, more concentrated in nature. It could be very specialized and very tactical. You can use single individual stocks, single stock ETFs, leverage ETFs, long short funds, hedge funds, active funds. These are all the types of investments in the non-core container, and that's exactly where they belong. So sector funds, which we're looking at on this slide, fit the bill of what we would call non-core, right? Because they're more concentrated in nature, higher risk, and they're not really proxies of the major asset classes we discussed previously, in this case, stocks. We've got three leaders, three relentless leaders that have been really powering the S&P 500: technology, energy, and industrials. Those are the three leaders. And energy stocks have come off their highs. We've seen a little bit of a pause in the run-up in oil prices. Some analysts think that's temporary. We will just have to see if any of these peace accords between Iran, the United States, and Israel have any durability, and if they're honored. If not, we could see a spike up there in energy prices once again. You'll notice, too, the sheer number of S&P industry groups: 8 are up, 3 are down. The 3 that are down are modestly down. And so the overall sector trend that's powering the S&P 500 continues to be up, okay? You got more sectors up than down. So no bear market story here just yet. In terms of, technology, really the semiconductors have gotten a lot of attention, and rightfully so. They've been great performers. And one of those within that group is Micron. And I just wanted to chart just to kind of help you appreciate and understand in the terms of a non-core portfolio, if you're going to use a single stock ETF, this is exactly where it would go. And leverage, if you're going to use it, the time to use it is when you're trading a specific asset. That, in this case, we're looking at Micron, but it could be something else. It could be commodities. It could be a sector. It could be bonds, whatever. But you want to use leverage, if you're going to use it, when that particular area is sharply trending in whatever direction that you're trading, whether that's up or down. And so leverage in a flat market is not optimal and not useful. It's not going to help you. It's going to probably degrade your portfolio. But in this case, we've got Micron, which is a perfect example of a sharply trending stock that has been going up. And so MUU, which aims for 2x bullish exposure to Micron, you can see since the start of the year, it's up over 900%. That's a 9x return in about 6 months. So again, I'm not saying you should buy it and hold it for 6 months. Those of you that did, you did very well. But my point is that this just illustrates the kind of money and outcome that's possible with trading sharply trending assets that are going in the same direction as you. Now, that said, there's still many tech giants that are in a deep bear market. And this was from the Kobesi letter, and it highlighted how many really top-notch companies are really, really in the toilet as far as their stock performance here in 2026. That was quite alarming. I mean, you've got some really great companies on this list that are in a bear market, 20% or more off their all-time highs. So again, stock picking's hard, and I'm not saying that any of these stocks are necessarily long-term losers, but you certainly can see some of the pain being felt. And again, is it a warning sign for the broader market? Usually that's when you see cracks in the market, is when individual stocks start to kind of sell off, and we haven't seen a broad sell-off in the market just yet, but again, something to watch, something to pay attention to. This is another example of how markets have a short memory and an even shorter attention span. 1 minute, you can have a company that's a cultural icon, a can't-miss brand, and a permanent fixture in every portfolio. And then the next thing you know, it's fighting for its life. And Nike is a perfect example. It's down 75% from its 2021 peak, largest drawdown in history, 75%. And again, this is a reminder that even the bluest of blue chip stocks can get absolutely hammered when market mood shifts. Now, this is not about Nike alone. I'm not picking on Nike, but it's really illustrative of a market that's become increasingly finicky, unforgiving, and hypersensitive to consumer-driven weakness. And companies that rely on discretionary spending are discovering that the consumer's not a bottomless well. And so Wall Street may have assumed that before, but we can't assume that going forward. And so when sentiment tightens, when wallets close even a little bit, stocks tied to those behaviors often crater. And that's what we're seeing here with Nike. And the real lesson, again, I think, is brand strength alone doesn't equal great stock performance. Even giants can bleed, and even icons can fall out of favor. And in a market this temperamental, and investors who assume that, well, it's a blue chip, it's going to be fine, well, they're learning that nothing is immune. Not earnings, not reputation, not brand, not history. Market doesn't care about how beloved a brand is or a company is, only how vulnerable it looks. So lots of lessons there. Does anybody care about interest rates? I mean, we should. We should care about interest rates because interest rates impact markets like never before. And so this is kind of a look at the Fed Watch, a CME group, which tracks this. This is a tool that they use to assess the probability or chances of interest rate hikes. And according to some of their data, this is for the July meeting. The Fed meets on July 29th, so we're giving you heads up. 30% chance of an increase in interest rates by, actually, this is not by September, but at that meeting at the end of July. Now, I wanted to compare and contrast this with what they think about September's meeting, because September's meeting has a 60% chance of a rate hike, again, at that September 16th meeting. So big difference in what the market thinks about interest rates rising at the July meeting with the Fed versus September. So very low probability that we'll see a rate hike in July. Much, much higher probability that we'll see a rate hike in September. And so what is that going to mean for rate-sensitive assets? Well, this is a chart of preferred securities, which are very sensitive to higher interest rates or fluctuating interest rates. And I wanted to chart PFLD versus PFF. PFLD, in my opinion, if you're going to invest in this sector as an income investor or preferred securities, it's the superior built vehicle because it's less sensitive to any changes, upward revisions in interest rates, which seems like we're heading into that sort of environment. And so you can see what happened in 2022 when interest rates skyrocketed, and you'll see PFLD did a lot better than its rival PFF, and it also has delivered some upside, a lot less volatility on the upside, but performance over the past 5 years that has been slightly better with lower volatility. And so, again, if we're heading into an interest rate environment of higher rates, PFLD is going to probably do a lot better than some of its peers in this space. So check out PFLD. We've talked about it on the channel before, and I think it's worth a look. Now, what about financial icebergs? You know, there's so many things that could derail your investment portfolio, warning signs. Let's take a look at what Jeremy Grantham had to say about this.
Great market peaks like this are traditionally followed by the worst of times. So don't kid yourself. Now, the great exception is 2022. In 2022, all the conditions of a major bubble are met, and it breaks, and the S&P drops 25%, the Mag 7 drops 40, growth stocks about 30, 35, and the bond market has the worst year in its history. So 22 is an ugly year.
So it's all about protecting yourself and being ready for whatever happens. And getting back to that framework of building an architecturally sound investment portfolio, that's what the safety container is supposed to do. These are some examples of assets that meet minimum safety standards. But I've got an upcoming live event that you're all invited to. You can hit the description section below. It's coming up on July 23rd. It's completely free. We're going to go over ways to de-risk your investment portfolio without going to cash. And sadly, most investors don't really realize how much risk they're taking until it's far too late, until the market has dealt them a blow. And so we want to prepare you, not saying that the market's going to crash, but we got to be ready for anything. And so that's what this live event will do. It'll help prepare you. I also got a couple of excellent bonus reports for those of you that attend live. My blueprint for building a architecturally sound investment portfolio, plus steps for de-risking your investment portfolio. So be sure to hit the description section below. That's free to all. It's going to be happening on July 23rd, but you do need to register. Let's finish up with our Bloomberg Billionaires Index. And you can see, I highlight this. This is where the big money made its money, and this is where the big money is still allocated. Is there any industry sector in the world that's created more billionaires than technology? Well, I can't name any. And you can see that from an investment perspective, that's still the great lesson, is to orientate and align the portfolio with technological advancements and changes. That's what's building wealth, and it will continue to do that. And so you can see the top 10 billionaires globally, 8 out of 10, that's where they made their money in technology. So that's a great lesson for all of us. In terms of where you can find ETF Guide TV, everywhere. Besides YouTube, you can also see us on Apple TV, Roku, and also Amazon Fire. And then we've got some new episodes coming up, so stay tuned for new episodes, Metals in Motion, and also First Look ETF with the New York Stock Exchange, so don't miss it. Hit me up in the description or in the comment section below. I'd like to hear your thoughts, and let me know how you're doing. I'm Ron DeLegge with ETF Guide. Thanks for watching. We'll see you on the next show.